All right, let's get right into it. Today, we're pulling back the curtain on the financial blueprint that high net worth individuals actually use. And look, this isn't just about making more money. It's way deeper than that. It's about understanding the systems that control how your money moves and grows.
So you gotta ask yourself this, right? Why is it that some people who make a ton of money, I'm talking doctors, lawyers, top executives, end up building real, lasting wealth, while others just seem to be on a financial treadmill, paying a whole lot more in taxes? The core issue, as the analysis shows, isn't really about the size of their income. It's all about the structure of their finances. And that right there is the key idea. You see, lasting wealth isn't some happy accident that comes from a big salary. No, it's the result of a deliberately engineered system. It's a fundamental shift in thinking, from just earning an income to actually building a machine that generates wealth. So, let's break down this blueprint. The main idea, the big principle, is moving from being just a piece in someone else's system, trading your time for money, to becoming the owner of systems that create value all on their own. This perspective is absolutely crucial. The real goal isn't just to have a giant number in your bank account. It's to build a self-sustaining financial engine that compounds, that grows, that spits out cash flow all day, every day efficiently. So, how do you actually build this system? Well, the foundation, the very bedrock of it all, is built on one critical activity: acquiring the right kind of strategic assets. Everything else is constructed right on top of this. Now, what's really fascinating here is the intentional balance. A high net worth portfolio is almost never just dumped into one single thing. It's a diversified structure, carefully engineered to balance risk, cash flow, and long-term growth. But the strategy goes way deeper than just what is owned. It's all about the why. Each one of these asset classes has a very specific job to do. Real estate, that's for cash flow and growth, supercharged with leverage, using other people's money and awesome tax benefits. Index funds, that's your stable foundation, the core that just compounds over the long haul. Precious metals act like your financial insurance policy, a hedge to protect your purchasing power when inflation or markets get crazy. And then you've got digital assets, which offer what's called asymmetric growth potential, where a small piece of your portfolio has a shot at outsized returns. Every piece has a purpose. Okay, so once that asset base is set up, the next layer of the system gets engineered, creating multiple, totally independent streams of income. This is the secret sauce for building real financial resilience. Analysis shows that relying on a single paycheck is one of the biggest roadblocks to building wealth. So the blueprint calls for diversifying your income itself. It becomes this self-reinforcing cycle. Profits from a business can be used to buy real estate, which then produces rental income. That income can then be invested in the market to generate dividends. See how it works? And the target number, according to the experts, is often 5 to 7 or even more distinct streams. This isn't just for the sake of it. It's about creating an integrated system where if one stream dries up, it doesn't really affect the whole structure. That diversification gives you incredible stability and real financial power. Now we get to the accelerator in this wealth machine, mastering the tax code. You've heard it a million times. It's not what you earn, it's what you keep. Well, tax strategy is the absolute key to keeping as much as you can. This is a massive shift in how you look at things. For most people, taxes are a burden, a liability. But for the financially savvy, the tax code is more like a guidebook full of government incentives. It rewards you for doing certain things, like creating jobs, providing housing, or investing in the economy. So the goal is to line up your financial moves with those incentives. Let's look at a classic example of this: the S-corporation structure. So a business owner sets up an S-corp. They pay themselves a reasonable salary, which, yes, is subject to payroll taxes. But then, and this is the important part, all the rest of the profits are taken as distributions. So why is this such a big deal? It's a huge deal because those distributions are not subject to self-employment taxes. Just look at this side-by-side comparison. On an income of $200,000, the S-corp owner pays self-employment tax on only their $80,000 salary. But the sole proprietor, they're paying it on the whole $200,000. This one structural decision translates into thousands of dollars in tax savings year after year after year. And the S-corp is just one tool in a massive toolbox. The system is layered with all sorts of other incentives. Things like depreciation on rental properties, which can create paper losses to offset other income, or 1031 exchanges to put off paying capital gains on real estate. Plus, there are all kinds of sophisticated retirement plans designed to shelter huge amounts of income from taxes. And finally, this blueprint, this system, it's designed to go way beyond just a single lifetime. The ultimate goal isn't just creating wealth for yourself, but preserving it and passing it on efficiently from one generation to the next. One of the most powerful and honestly least understood tools for this is something called the step up in basis. It's basically a provision in the tax code that resets an asset's cost when someone inherits it. And in doing so, it can completely wipe out the capital gains tax. Now, that might sound a little abstract, so let's walk through a really simple example to see just how powerful this thing is in the real world. Okay, let's start with an asset. We'll say it's a piece of real estate that was bought for $300,000. That's our starting point, the original cost basis. So, for decades, the owner just holds on to this property, they don't sell it, and over that time, its value grows a lot. Now, let's say at the time of their passing, that same property is worth $800,000. That's a $500,000 gain that has built up over the years. And here is the magic. When an heir inherits that property, their cost basis isn't the original $300,000. It steps up to the current market value of $800,000. So if the heir turns around and sells it right away for that price, guess what? There is zero taxable capital gain. So the bottom line is that the entire $500,000 increase in value that happened during the original owner's lifetime is never, ever taxed as a capital gain. This is an absolute cornerstone of preserving wealth for generations. And all of this brings us back to the final, most important question. Is your financial plan based on the rules of earning? Trading your time for money and just paying whatever taxes come with that? Or are you actively engineering a system to build, protect, and pass on real wealth? The blueprint is out there. The choice of which game you want to play, well, that's up to you.